The mathematically perfect investment strategy says you should never pay off your mortgage early. The interest rate is low, the market returns more. Hence, keep the mortgage, invest the difference. The math is clear. The spreadsheet doesn't lie. But what if paying off your mortgage lets you sleep at night? What if the peace of mind is worth more than the extra 2% return? What if the wrong financial decision is actually the right one for you? This is Chapter 11 of The Psychology of Money. Reasonable is better than rational. This chapter challenges something that the entire financial industry takes as gospel, that financial decisions should be purely rational, based on data, based on math, based on spreadsheets and optimization models. Morgan says no, financial decisions should be reasonable, and there's a critical difference. A rational decision is the one that maximizes returns on paper. It's the theoretically perfect choice, the one a computer would make. A reasonable decision is the one you can actually live with, the one you can stick with through fear, panic, and uncertainty, the one that lets you sleep at night, the one that accounts for the fact that you are a human, not a spreadsheet. And Morgan's argument is simple but profound. A reasonable strategy you can follow for 30 years will always beat a rational strategy you abandon after 6 months. Because here's what happens in real life. Someone reads about the mathematically optimal portfolio, maybe it's 100% stocks, because historically stocks outperform everything over long periods. The math says, go all in. So they go all in, and then the market drops 30%, and they can't sleep. They check their portfolio every hour. Their spouse is worried. Their hands shake when they open the app, and after 3 months of agony, they sell everything. At the bottom, locking in massive losses. The rational strategy didn't fail because the math was wrong. It failed because the human couldn't handle it. A less optimal portfolio, maybe 60% stocks and 40% bonds, would have dropped less, felt less terrifying, and they would have held it. Over 30 years, that reasonable portfolio they stuck with would crush the rational portfolio they abandoned. That's the entire lesson. You are not a robot. Stop investing like one. Let's look at our first story, Jack Bogle's home bias. Let me tell you about someone who understood this perfectly. Jack Bogle, the founder of Vanguard and the inventor of the index fund. Bogle is one of the most important figures in the history of investing. He democratized investing for millions of people. He understood markets, diversification, and portfolio theory better than almost anyone alive. And yet, Bogle kept the vast majority of his portfolio in U.S. stocks. Almost no international diversification. Financial theory says you should own stocks from around the world. U.S., Europe, Asia, emerging markets. Concentrating in one country is irrational. When asked about it, Bogle essentially said, I'm comfortable with it. I understand these companies. I sleep well at night. I don't need the extra diversification to feel secure. Was it mathematically optimal? Probably not. Was it reasonable? Absolutely. And because he stuck with it patiently, for decades it worked out phenomenally well. A financial advisor would have told Bogle to diversify internationally. But Bogle knew something the advisor's spreadsheet couldn't capture. The best portfolio is the one you'll actually hold through thick and thin. Let's look at our second story, the home ownership debate. Here's another example that will resonate with almost everyone watching this. Financially speaking, renting is often more rational than buying a home. When you factor in mortgage interest, property taxes, maintenance cost, insurance, and the opportunity cost of your down payment, the math is clear. But millions of people buy homes anyway. Why? Because owning a home feels different. It feels stable. It feels like yours. You can paint the walls. You can plant a garden. Nobody can raise your rent or evict you. Your children grow up in the same house. Is buying a home always rational? No. Is it reasonable? For most people, yes. The emotional security, the sense of permanence, the pride of ownership, these are real benefits that don't show up on a spreadsheet. And here's the key. Because owning a home feels so good, people stick with it. They keep paying the mortgage. They don't panic and sell. They stay for 20, 30 years. And over that time, the home appreciates, the mortgage gets paid off, and they end up with a significant asset. A renter who theoretically should have invested the difference, in reality, they often spend it. Because without the forced discipline of a mortgage payment, the rational savings plan falls apart. Let me show you this principle in action with something that millions of people experienced very recently. In January 2021, the world watched one of the most extraordinary events in stock market history. Retail investors on Reddit, specifically a forum called Wall Street Bets, started buying shares of GameStop, a struggling video game retailer. The stock went from about $20 to nearly $500 in a matter of days. From a purely rational perspective, GameStop at $483 made 0 cents. The company was losing money. Stores were closing. The fundamentals didn't support anything close to that price. Every financial model, every analyst screamed, "Don't buy." And if you hold it, sell immediately. And many professional investors did exactly that. They shorted the stock. They were rational. They were right about the fundamentals. But here's what happened. Many of the retail investors who bought GameStop weren't optimizing for maximum financial return. They were doing something else entirely. They were making a statement. They were fighting against hedge funds they felt had rigged the system. They were part of a community. They were having fun. When the stock crashed, many of these investors didn't panic. They held. They called themselves diamond hands. They posted memes about never selling. Some of them are still holding years later, even at massive losses. Now, a rational investor would say these people are fools. They held a losing position based on emotion, community identity, and stubbornness. The spreadsheet says sell, but Morgan's framework asks a different question. Were they reasonable for them? And the answer, surprisingly, might be yes. If the cost of selling is the feeling of betraying a community, of giving up on something they believed in was emotionally higher than the financial loss, then holding was reasonable for them, not for a hedge fund, not for a financial advisor, for them. Now, I want to be very clear. I am not saying meme stock investing is a good strategy. It's not. Most people who bought GameStop at $400 lost significant money. Financially, it was a disaster for many. But the lesson Morgan teaches in this chapter isn't about GameStop. It's about understanding that humans don't make decisions in a vacuum. They make decisions inside a web of emotions, identities, relationships, and personal values. And any financial strategy that ignores that web will eventually be abandoned. The hedge funds who shorted GameStop were rational, and some of them lost billions. Melvin Capital, one of the most prominent short sellers, lost 53% of its value in January 2021 alone, and eventually shut down entirely in 2022. They were rational. They were right about the fundamentals. And they still lost because they didn't account for the fact that their opponents weren't playing the same game. The Reddit investors weren't being rational. They were being reasonable by their own definition, and that made them unpredictable. The takeaway isn't buy meme stocks. The takeaway is when you build a financial plan, build it for a human, not for a spreadsheet, because the human is the one who has to live with it. This chapter gave me permission to stop feeling guilty about my financial decisions. Because I've done things that influencers would roast me for. I've paid off debt early when the math said not to. I've kept money in a savings account, earning almost nothing because I liked knowing it was there. I've chosen a lower return investment because I trusted the brand more. And every time, there was a voice in my head telling me I was doing it wrong. I was leaving money on the table. I was being irrational. But you know what? I stuck with every single one of those decisions. For years, I never panic sold. I never abandoned my strategy. I never lost sleep. And that consistency, that ability to hold my strategy through good times and bad, has done more for my wealth than any optimization ever could. There are 3 takeaways from this chapter. First, asset allocation. The rational portfolio for a 30-year-old with a long time horizon might be 100% stocks. Over 30 years, stocks beat everything. But if a 40% market crash would cause you to sell everything in panic, then that's not your portfolio. Maybe 70% stocks and 30% bonds, which is suboptimal. But if it lets you hold steady during a crash, it's better for you. Second is paying off debt versus investing. If your home loan charges 8% interest and the stock market averages 12%, the rational move is to invest, not prepay the loan. You earn more than you save. But if that home loan keeps you up at night, if the weight of debt makes you anxious, stressed, and unable to focus, then pay it off. The peace of mind has real value. It improves your health, your relationships, your work performance. Those returns don't show up on a spreadsheet, but they're very real. Third is measure your financial strategy by how long you can sustain it, not by its theoretical returns. A 10% return strategy you hold for 30 years beats a 15% return strategy you abandon after 2 years. Every time, without exception. Sustainability is the strategy. That's Chapter 11. Reasonable is better than rational, the chapter that finally gives you permission to be human with your money. In the next video, we cover Chapter 12. Surprise! Morgan argues that history is not a reliable guide to the future. The most important events in financial history were things nobody predicted, and the next world-changing financial event, nobody will predict that either. Like this video if it resonated, subscribe if you're on this journey. We're past the halfway point, and every chapter is building on the last. And tell me in the comments, what's one irrational financial decision you've made that you don't regret? I bet the answers will surprise everyone. See you in the next one.